Introduction. Here's what you'll discover in this video: a powerful decision-making framework for prioritizing debt versus investment, your personal wealth-building formula, and the 3 types of debt you should never carry while investing. By the end, you'll have a clear action plan customized to your situation. After helping people successfully implement this system, it has resulted in an additional $18,400 in net worth growth per year compared to traditional methods, a figure we'll explore through actual client examples. This transformation mirrors what happened with Jason, whose financial breakthrough you'll see in our detailed case study. Stay tuned to witness how his struggle turned into a wealth-building success story. Meet Jason drowning in debt while dreams of investing fade away. Meet Jason. He's 28 years old and just opened his student loan statement, $43,000 still remaining. That same day, his friend texted him about making $4,500 from investments in a market that's up 22% this year. Jason felt that familiar knot in his stomach. Should he focus on paying off his debt or start investing like his friends? Jason makes $65,000 a year at his marketing job, but he's been stuck in financial limbo for years. Every month, he makes minimum payments on his debts while keeping his extra cash in a savings account, earning 0.5% interest. He's been told this is the responsible thing to do: build an emergency fund and pay down debt before investing. After following this approach for 5 years, Jason did the math and realized something painful. If he had invested that money instead, he could have earned over $28,000 in returns based on average market performance. That's money he'll never get back. His anxiety grows with each passing month. His phone buzzes with market updates while he stands frozen in the grocery aisle, debating whether to buy name-brand cereal. His student loans at 5% interest seem endless, while $8,000 in credit card debt at 18% interest compounds whenever unexpected expenses arise. This financial stress permeates everything. He hesitates to change jobs or move to a better apartment. He cancels plans with friends to save money. His debt has become a psychological burden influencing nearly every decision. The advice Jason receives only adds to his confusion. His dad insists he eliminate all debt before investing. His co-worker urges him to max out his 401k for the company match. Financial articles contradict each other. Some advocate the debt snowball method, while others emphasize the opportunity cost of delayed investing. Then came the shocking revelation: waiting until his debt is fully paid before investing would cost him approximately $122,500 in compound returns over the next decade. The potential loss from delaying investment exceeded his total debt. What Jason needed was a clear framework to decide which debts to attack aggressively and which ones to pay minimums on while directing funds to investments. The interest rate comparison method would have shown Jason which approach would build more wealth. His credit card debt at 18% is mathematically impossible to outperform with typical investments. Every dollar toward that debt essentially earns him an 18% guaranteed return. But his student loans at 5%, that calculation gets interesting when retirement account tax benefits enter the equation. Let's rewind and see exactly how Jason could have made better decisions using 3 key principles that anyone can apply. These principles work regardless of debt amount or type. The solution isn't choosing between debt payoff or investing. It's knowing how to allocate your money between both goals to maximize long-term wealth. Let's examine the decision framework that would have changed everything for Jason. The wealth-building decision tree: when to pay debt versus when to invest. What if I told you there's a simple mathematical formula that tells you exactly which debts to pay off first and which ones to minimum pay while investing. It's something you can figure out in about 5 minutes with a calculator. I call it the interest rate threshold method, and it works by comparing what you expect to earn from investments against what you're paying in interest on your debts. This comparison shows you where your money works hardest. Think of it like deciding between two job offers. You choose the one that pays better, right? You want your dollars working at the highest paying job possible. Most people get this calculation wrong because they miss two major factors. Please like and subscribe if you like the videos, and share with your friends and colleagues. The tax advantages that come with certain investments and the psychological impact of carrying different types of debt. Both dramatically change where you should put your money. For example, if you're paying 18% interest on credit card debt while earning 10% in the stock market, you're losing money every day. The math is clear. Eliminating that 18% interest payment gives you a better return than most investments could. Here's a practical guideline: the rule of 7%. Any debt with interest higher than 7% should generally be prioritized over investing. This gives you a starting point, though there are important exceptions. Debt categories to consider: high-interest debt, 15 to 25%. Tackle first, as it destroys wealth faster than investments build it. Medium-interest debt, 6 to 7%. The gray zone, where tax advantages might make investing more profitable. Low-interest debt, often worth minimum payments while investing elsewhere. For instance, if your employer matches 50% of your 401k contributions, that's an immediate 50% return before investments even grow. This easily beats paying extra on a 6% loan. Remember Jason's situation? With $5,000 available annually after minimum payments, he should allocate $2,000 toward his credit card debt, 18%, $1,500 toward his 401k to get his employer match, 100% return, $1,500 toward his student loans, 5%. This approach would increase Jason's net worth by approximately $18,400 per year compared to focusing only on debt by capturing the employer match, preventing additional high-interest debt, and still making progress on student loans. The optimal approach is usually tackling different financial goals simultaneously, with specific amounts allocated to each based on interest rates and returns. Think about your financial life like a garden. Some weeds, high-interest debt, need immediate attention or they'll overtake everything. But you shouldn't wait to plant tomatoes, investments that need time to grow. You can address both on the same day. The interest rate threshold method gives you a clear formula for making the optimal decision with every dollar you have. The 3-account system, building wealth while eliminating debt. Imagine watching your net worth grow every month, even while you still have debt. This isn't some fantasy, it's what happens when you use a system designed to build wealth and eliminate debt at the same time. Let me show you exactly how it works. The problem with most financial advice is it treats all your money the same way. You've probably heard people say, pay off all debt first or always invest first, but these approaches ignore how money really works. The solution is the 3-account system. This system creates strategic buckets that work together like a financial garden where multiple crops flourish simultaneously. While most people direct extra money toward either debt or investing, limiting their growth potential, you'll cultivate 3 different financial crops at once. Account hash 1 is your debt destroyer. It automatically directs a fixed percentage of income toward eliminating your highest interest debts first. Once set up with direct deposits, the system runs itself. For Jason, dedicating $500 monthly to his credit card debt would eliminate it in less than 18 months. Each shrinking balance creates a psychological win that fuels motivation when debt anxiety would otherwise paralyze progress. Account hash 2 is your wealth builder. This captures employer matches and tax advantages through retirement accounts. The math is powerful. If your employer matches 50% of contributions, that's an immediate 50% return before investments grow. Jason's $200 monthly 401k contribution with employer matching adds $1,200 yearly to his retirement. Over 10 years at 7% average return, his $24,000 contribution becomes over $34,000. Account hash 3 is your opportunity fund. This builds cash reserves for emergencies and future investments. It prevents deeper debt when unexpected expenses arise and positions you to seize investment opportunities. Jason's $3,000 opportunity fund prevented additional credit card debt when his car needed repairs, creating peace of mind and accelerating his debt payoff. Which investments work best while paying down debt? Employer-matched retirement accounts often provide 50 to 100% immediate returns that mathematically outperform even high-interest debt payoff, except for loans above 15% interest. This three-account system creates wins on multiple fronts. Consider Alex, who eliminated $67,000 in debt while building $43,000 in investments over 4 years on a $72,000 salary. By dividing extra income across all three accounts, Alex created dual progress that maintained motivation far better than a single focus approach. The system works by aligning mathematical optimization with psychological motivation. You allocate money to its highest return use while experiencing progress in multiple areas, keeping you motivated long-term. Setting up takes less than an hour. You can start with just $50 per account. The key is consistency and proper allocation based on your specific situation. Conclusion: when I look back at Jason's situation, his biggest problem wasn't bad math. It was not having a system to decide where his money should go. That mistake cost him significantly over time. Your action step today is crucial. Calculate your personal interest rate threshold, list all debts by interest rate, then compare them to expected investment returns. Set up your three-account system this week without delay. Remember, waiting until you're completely debt-free often slows your wealth-building journey. Strategic investing while tackling high-interest debts transforms your financial future dramatically. Take this step now. Each day of indecision has a real cost to your long-term wealth.